Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York headquarters. You're watching our brand new show aimed at giving you, the viewers, the ultimate investing playbook. We'll help you tune out the noise and make the right moves for your money.
From today's top stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we'll dig deeper into everything you need to know for the last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I don't want to put the label on it. Other people can do that, but I would just say we're using our tools to, keep a strong labor market and strong growth, while, making further progress on getting inflation down to 2% for the benefit of the public.
If the Fed eases too soon before inflation is assuredly at its goal, market participants are going to rally a lot, and if inflation doesn't fall, it's going to be even more stubborn because of the easing of financial conditions.
I think earnings this year is going to be the big differentiator versus what the Fed does, because I don't see the Fed doing a whole lot this year. If the economy is strong, at the end of the day, there's only two things that determine stock prices, right? It's earnings and the multiple you put on.
The election starts right now. The campaign for the fall starts right now. We are going to have one of the longest campaigns that we've ever seen.
So we've got 1 hour to go until the market close, and let's get you up to speed on the market action. We start with the major indices here, and it sort of echoes what Dan Niles was just talking about, that the Fed is not necessarily going to set the narrative. And indeed, Jay Powell on Capitol Hill today didn't say anything to upset the apple cart. So we see the Dow, which yes was higher earlier in the session, but little changed right now, up just about 6.5 points. The S&P 500 up about 1/3%, and the Nasdaq up about 0.4%. We should also check in on interest rates in the wake of his comments, and there we don't have much change either, down about 3 basis points here to 4.1% on the 10-year. So that's where we stand on that front. I also just quickly wanted to check on what we are seeing sector-wise in the S&P 500. Only one group in the red, that is consumer discretionary. We've got utilities and consumer staples leading the way today. And Josh, over to you for a stock that we are watching.
Well, Julie, we got to talk about NYCB here, New York Community Bank Corp, because we have big headlines dropping here. They have now indeed raised $1 billion from private investors. That includes Hudson Bay, Reverence Capital, and, by the way, the firm managed by former Treasury Secretary Steve Mnuchin. Also announcing a new CEO, Joseph Otting. He's going to be the new CEO in charge there. Alessandro Danello, who, remember, was actually just recently named CEO. He's going to remain non-executive chairman at the bank. Earlier today, we did have a headline. They were talking to investors. You saw that headline cause a big drop in the stock. It cratered, but now the news is confirmed. They've secured this $1 billion injection. Last time I did check, the stock was halted, but we'll see how investors react, Julie.
Yeah, I'm taking a look at, well, it looks like it has still been halted for volatility here. Originally it was halted pending news, then the news came out, and then you saw that big jump in the stock. And what happens when you see big moves like that and you have automatic trading halts. So now it looks like it might be trading once again. It's kind of bouncing around here. But to your point, there had been a lot of concern about this bank specifically, and some concerns raised about whether we were going to get a redo of last spring with the collapse of Silicon Valley Bank. Most of those concerns, broader concerns, have been brushed off to some extent, but still there were questions about whether this bank was going to be able to continue in the same form. I don't think those questions have been entirely resolved with this equity raise, but they've been perhaps delayed.
Yeah, and to your point, you don't want those questions if you're a bank. I mean,
you definitely don't.
This is confidence. That's what they're trying to do, restore confidence, investors, they restore confidence to the regulators they know who are closely watching, and of course, make sure their depositors feel secure.
Yes. The backdrop for all of this, of course, is Jay Powell and his comments today. So let's get to that. Investors, of course, keeping an eye on commentary from Fed Chair Jerome Powell as he wraps up his first day of congressional testimony. Jennifer Schonberger is on Capitol Hill with the latest. Jen, bring us the highlights.
Julie, in his first day of semi-annual testimony before Congress, Fed Chair Powell told House lawmakers that the Fed will cut rates at some point this year and said that he expects broad material changes to the Fed's proposed capital requirements known as Basel III. Today's message was unchanged, with Chair Powell reiterating that while the Fed doesn't need to see inflation drop all the way to 2% before cutting rates, officials do need to see more good data to feel fully confident that inflation is moving lower in order to cut rates. Take a listen.
We don't want to have a situation where it turns out that the 6 months of good inflation data we had last year, that didn't turn out to be an accurate signal of where underlying inflation is.
Democratic ranking member Maxine Waters focused on housing, saying it's the #1 driver of inflation. In an interview following the hearing, Waters told me that she would like to see the Fed target inflation higher than 2% and would like to see the Fed lower rates as soon as the March policy meeting.
I'm absolutely convinced that these rates should be lowered. That people are paying a disproportionate amount of their income for things that are necessities like food. And so we've got to bring those rates down.
So you'd like to see the Fed lower rates as soon as their March 20th policy meeting later this month?
Yes, absolutely. I'm optimistic every meeting.
Meanwhile, Republicans focused on the Fed's proposed capital requirements, with Committee Chairman Patrick McHenry asking Powell to revoke the proposal and start over again. Powell says that while decisions have not yet been made, he wouldn't rule out doing just that, calling it, quote, a very plausible option. He says the Fed wants to take its time and do it right. Back to you.
Jennifer Schonberger, thank you. Appreciate it. Now, for more on today's comments from Fed Chair Jerome Powell and what they mean for the markets as well as the fight against inflation, let's welcome in Seth Carpenter, Morgan Stanley Chief Global Economist. Seth, always good to have you on the show.
Thanks for having me here.
So listen, Jay Powell testifies, we didn't expect him to rock the boat. He didn't. I mean, listen, the economy's strong, he said, labor market's strong, inflation's moving in the right direction. I think he put it like he wants to see a bit more good data, right? But what were your big takeaways? What did you learn?
No, I think exactly that. I think he is at a point where they can't be definitive. The recent data, in fact, if anything, have been stronger than we've expected, the markets expected, probably the Fed's expected. The trick is to figure out how much of this is a blip. If we look back over the past 2 years, the labor market rate has been gently cooling a little bit, and then every so often, boom, a really big month of non-farm payrolls, and then it goes back to the trend. That's presumably what Powell and company are assuming. That's what we're assuming is the takeaway. So we'll see, Friday morning. And so what he wanted to do, I think, was nothing. Essentially leave things the way Julie was talking about with the market reaction to it, which is as little change as possible, preserve optionality. I have to say right now, the market pricing is very consistent with where we've been for a while, which is to say, first cut probably in June. Total of about 100 basis points worth of cuts over the rest of the year, but there's got to be some uncertainty. We've got to see the data between now and then.
On a day like this, when we see Powell before Congress, you of course get sort of two versions of America, right? You get the version that Ayanna Pressley, for example, brought up, where she said interest rates need to come down to make housing more affordable. And then you had Patrick McCarthy, who's the chair of the committee, saying, don't make this political. Don't bring down rates, effectively saying, don't bring down rates before they need to be. And it just leads me to think about sentiment in those sort of two visions of where we are economically. Like, how do you think about kind of where we are with inflation and what those views reflect?
It's a super difficult situation. We had a bout of inflation that is worse than just about anything we've seen. I'm in my early 50s. I don't look it, but I'm in my early 50s. And by the time since the time that I've been like a conscious adult making real decisions, we haven't seen inflation like this. So I think in that regard, it's a big deal, and lots of people are worrying. We're worrying for a while. Is this a replay of the 1970s? The answer is clearly no at this point. We didn't think it was going to be, but people had to understand that. On the other hand, the economy is strong. And that strength, if it continues unchecked, could mean that some of the residual inflation stays there forever. And so the Fed, with a very blunt tool, interest rates, is trying to slow the economy enough that inflation's under control, but not so much that they cause a recession. Well, the most interest-sensitive parts of the economy are housing, consumer durables, and people really feel that. Anyone who has to borrow in order to buy things, which is a lot of people, really feel that pain. On the other hand, everybody knows that inflation is too high. Everybody has seen those prices going up. And so the Fed really is stuck between a rock and a hard place, and they're trying really hard to balance things.
And you think, Seth, the first cuts come in June. Does that exact timing actually matter, though?
No. I have to say, as a macroeconomist who has spent probably too much time working with statistics, there's lots of fuzziness always with these sort of big picture data. I think right now with the market anticipating some easing later in the year, probably some additional easing next year, that's about what matters. If it happens in June, if it happens in July, I don't think that's what's most important. What I think is important is the Fed continuing to communicate a reasonably coherent message, and that's where we are.
Does the pushback of the Fed's first interest rate cut, does that affect what we see from central bankers around the globe in terms of their strategy?
I think it does to varying degrees. So for example, I will call out my colleague Chetan Nayak, who's our chief Asia economist, and has been pretty adamant. A lot of Asian central bankers are going to be waiting for the Fed. They don't want to move in front of the Fed. They don't want to put at risk any exchange rate stability. I think to a lesser degree, across the Atlantic, we've got the European Central Bank. We technically, in our forecast, have them cutting before the Fed, but by a matter of weeks, so both of them at the June meeting, so I don't think that really counts. And so one question that I get from clients all the time is, well, suppose, for whatever reason, the Fed doesn't cut at all this year. Does that mean the ECB can't cut at all? And I don't think the answer is not at all. It just means probably less than would have been the case if the Fed followed through with all those cuts. Central banks have to worry about those interest rate differentials. They feed through to exchange rates, which then feed through to their domestic inflation. So it matters. It's not the whole story, but it's got to be one of the components.
And Seth, I'll get you out of here on this. ADP report this morning is 140,000, a bit less than expected, but it's still strong. What are you looking for on Friday? Get the big government report.
Absolutely. Like I said, the last jobs report was super strong. We think that was something of an anomaly, and we're looking for a bit of a reversion. So 160,000 on private payrolls, about 205,000 on total. So that obviously the difference is government employment. I think it's important to remember every cycle it's the case that government employment, be it federal or state and local, it sort of lags the rest of the cycle. And so we're seeing bigger contributions from that part. But for private payrolls, we're looking for things to settle back down about 160,000.
All right, we'll see how it goes. Seth, great to see you. Thanks so much for
Thank you
coming
for having
in.
me.
Really appreciate it. And we're just getting started here on market domination. Coming up, Abercrombie & Fitch forecasting upbeat revenue growth in its latest earnings report. Yahoo Finance executive editor Brian Sozzi speaks to the company CEO Fran Horowitz on the other side of the break. Plus, the newest edition of our series, Goodbye or Goodbye. We'll get investor insight on 2 stocks to help you make the best choices for your portfolio. Stick around, more market domination still to come.
One of the most remarkable stories in all of retail continued to play out in the holiday quarter. That is really the ongoing turnaround of Abercrombie & Fitch. Let's get right to the CEO making it happen. That is Fran Horowitz. Fran, always nice to get a few minutes with you, especially on an earnings day. You really said something really interesting to me on your earnings call. You said last year was a defining year for your company. Explain that further to us.
Absolutely. So in June of 2022, Brian, we came out with an investor day when things in the world were not particularly looking great. And it took a lot of courage to come out at that point and state our always forward plan, which was achieving 4.1 to 4.3 in top line revenue and on or about an 8% operating margin. And I will say overall, the day was received well, but very cautiously. Now to have hit those targets for the most part 2 years early is a pretty incredible moment for us. And that's exactly why I said defining. Now our goal for 2024 is certainly to prove that those are sustainable and can continue to grow on top of that.
What's really remarkable to me, Fran, among many things this quarter, which will impact, it's that the economy is not out there growing 5% in terms of GDP. Wages aren't going through the roof. Consumers are making choices on where they want to shop and where they don't want to shop. They're out there taking vacations and maybe not buying apparel from a department store. Why do you think you've been able to grow the business the way you have with a customer set, let's say 20 years old to late 30s? In some cases, they don't have a lot of money.
Well, I think you said it. The customer has a choice and they're choosing us. That's because we have been able to get the product voice and experience really aligned and respond to what the consumer is looking for. And our journey for our consumer, honestly, Brian, today starts at 5. We do have our kids brand, which is also resonating, and we take them right through Hollister and then through their, adulthood into Abercrombie. But having the product that they are looking for and staying close and really truly listening to this customer, which our team has gotten very, very good at, is the big win. On top of that, our biggest learning coming out of COVID is this discipline on inventory and making sure that we are lean and mean and that we are reacting to the business on a weekly basis. So we sit down with the team and we make sure that we look at the best sellers, what's working, what's not working, and we feed that inventory every week and we chase what's working.
You're certainly, your team and your company, the outlier in specialty apparel, but there have been some signs of life. So there's some other good stories going out there in specialty apparel. Do you think we're watching just a rebirth of the specialty apparel industry where consumers are tired of spending an hour trying to find things they need in these large department stores and they're going back to specialty retailers?
Well, I think what's exciting for us is that our omni customer who shops both on our digital channel as well as in the stores is our most profitable customer. That's the one who can shop whenever, wherever, and however they choose to shop with us. So I do think that there's an opportunity to continue to stay focused on that consumer and make sure that their experience is truly a seamless one.
Is this the year, you talked a lot about trying to sustain these results. Is this the year where you try to prove to Wall Street that the past 18 months weren't a fluke?
Listen, I hope we've already proved that, but it's a very fair question. We came out of 21 with very strong results, and in 22, things were a bit more difficult for us because of the supply chain issues. And 23 is exactly that. It is a defining year that all of the work over the past several years of rebuilding the foundation of this company, getting these brands on the right trajectory, and getting close to that customer are paying off. Our playbook is paying off, and this customer is choosing us, and it couldn't be more exciting.
Why is Abercrombie & Fitch, why is that brand still outperforming Hollister?
So the interesting thing about the Abercrombie brand, Brian, I know you've been on this journey with me for a long time, is the fact that we have been able to change the addressable market. So it's no longer a teen mall brand. It's no longer shorts and T-shirts. It's truly a lifestyle brand. He and she join us, maybe in their early 20s. We are seeing that customer stay well into their late 30s or even early 40s. So that's number one.
Thank you for keeping me in there, Fran. I was going to flag you because on the earnings call, you said 20 to late 30s. I'm like, Fran just aged me out of Abercrombie. I'm still buying stuff from stores.
No, we love you. We love you as a customer.
Okay.
Absolutely not.
Go ahead.
But the second part of that is the fact that we've expanded this categories. So from YPB, our active assortment, to Best Dressed Guest, the wedding shop that we launched today was a direct result in listening to our consumer and understanding that wedding journey and how many occasions that she needs to be dressed for that. So continuing to add on all of these new categories has really been part of the win. Big part of the win. Apologies.
Well, I have one theme I'm seeing in these retailer results, and I think I saw it in yours too. Retailers are back to opening up stores. Not 10 stores a year, not 20 stores a year, something even bigger. And I also saw it in some of the home improvement retailers. You mentioned 45 store openings for your company this year, in addition to some remodels. What gives you the confidence to just up that pace or go even faster with openings? And are you going to take some of these openings back overseas?
So this is our third year as a net store opener. We have been on this journey of really reconciling our square footage in our stores for many, many years. So it's exciting to be back on the side of growth. We will open in 24 75 new experiences. To answer your question, the majority of those still will lean towards North America and Abercrombie, but we will be opening up stores around the world. As we continue to move on this global opportunity that we've called out, we will continue to see openings over the next several years. But this year will be focused more on the North America and on tilted towards Abercrombie.
Lastly, Fran, just doing some rough math, based on your annual sales from last year, you have about only $700 million until you hit a $5 billion sales goal that you outlined a couple of years ago. It was, to me, at that time, that was an aspirational number. Not that I was saying Frank can't and her team can't hit it, but I'm like, 5 billion sales, that's a lot. I mean, when do you think you could hit that number, and how do you get there? Is it a combination of opening new stores and just taking the brand overseas and further refining the assortment?
Yeah, so in 2022, back on that conversation about the Investor Day, when we put that aspirational target out there, we certainly got closer to the always forward portion of that 2 years earlier than we expected. So our goal this year is to really continue on the growth path to make sure that this profitability is sustainable and that we can continue to prove to everybody that we're on the right path. $5 billion is still our aspiration out there. We've got investments to make beyond stores, but also still into our digital business. We've done a lot of work and a lot of investment in that front as well.
Fran, I forgot to ask you this. On your website, Abercrombie, calling 90s nostalgia clothing. I wore this stuff. It felt like yesterday. I said, when did all this 90s stuff come back? I still have some of it in my closet, I think.
It's okay. It always comes back in a new iteration. There's always a reason to buy new clothes. And if you need a pair of those looser fitting, lower baggy jeans, we've got them for you.
Well, I will not be dusting off my Jinko jeans, but we will take that offline. Fran Horowitz, Abercrombie CEO, always nice to see you. We'll talk to you soon.
Let's check in on some of the top calls of the day. We'll start with Tesla shares. They're dropping for a third day in a row. Today's news, Julie, is that a very well-known Tesla bull, that would be Adam Jonas from Morgan Stanley. Adam takes out the red pen and starts cutting. Yeah, does maintain his buy rating, we want to stress that, but does cut his price target, takes that down to 320, and tells his clients the company could report a loss this year based on GAAP accounting. EV demand slowing, he tells them. Companies are dumping their EVs, hybrids competing for the marginal EV buyer, he says. And this coming, of course, as Tesla stock has really suffered a rough slide so far this year. We're down about 30% now.
Yeah, I mean, you could argue even that Jonas is a little bit late to the party. I mean, a lot of what he talks about in his note is stuff that other people who are not as sanguine on Tesla have been talking about in this market already. One of the interesting points here, he says that Tesla's product is relatively aged. That it is, that the other major automakers are sort of earlier in their cycles, which has been a disadvantage for them. At this point, he says, maybe Tesla's product is not as exciting. And many analysts on the street are waiting, of course, for them to come out with their next mass market automobile. So that's something to consider as well. He's also talking about the penetration of Tesla in the mature markets like California, for example, already. And he also, of course, talks about competition in China.
Yeah, I mean, you read this note, it was so downbeat. You kind of felt like, why is he still overweight? He explains to his clients, listen, because I think it's an auto stock, but I also think it's an energy play, an AI play, a robotics play. So he's sticking with it, despite what he acknowledges is just overwhelmingly, he says, bearish sentiment at this point.
Yes, definitely.
All right, we move on. Check out shares of Palantir. They are surging today after the company won a $178 million contract with the U.S. Army. Palantir is now going to build 10 AI-powered ground stations. These are battlefield systems that aggregate data from space and terrestrial sensors for long-range precision targeting and other missions. Not everybody, though, is a believer. RBC's Rishi Jaluria rates Palantir underperforming underperform, and he joins us now. Rishi, it is always good to see you on the show. Let's just get right into the reaction, Rishi. This stock is surging about 9% today on that headline. Do you think that move is justified, Rishi?
Yeah, thanks so much for having me, Josh. Always a pleasure to chat with you. Look, my perspective is, to me, the move up is probably not justified, right? This contract was known. I've been talking to a lot of my clients about this exact contract, similar size to what was expected. I believe it was contemplated in the guidance that management gave us on the Q4 earnings report. And look, I look at the stock right now. This company has a bigger market cap than Snowflake, a bigger cap than Atlassian, and I'm not sure that's justified right now.
Rishi, by the same token, I mean, you've been an underperformer on this stock for quite a while here, and it keeps going up. So what? Obviously, you are diverging from the popular perception of Palantir. What would need to change in that perception? Because it seems like the fundamentals are not necessarily going to change. What would need to change to make the street come to where you are on Palantir?
Yeah, absolutely. Look, I think you're right. The fundamentals are what they are. This is a company trading at 25 times revenue, growing less than 20%, which is unheard of in software. But look, I think what it takes is recognition that what Palantir claims to be and what they are two different things. I'm not saying there's no value in this technology. There absolutely is. There absolutely is an AI play that they can help enterprises get their data estate in order for generative AI. But what this is not a cutting edge generative AI company. This is not a company that is innovating when it comes to generative AI. And I think when that bridge or gap of what is the message they're communicating to investors, and particularly retail investors, and what is reality, when that starts to narrow, I think we're going to see this stock come back more towards my price target, which I think represents fair value for the company.
Well, let me ask you, just to push on AI, Rishi, how many customers do we know now are using and paying for AIP, the company's AI platform?
Based on my checks, that answer is very, very few. They talk a lot about boot camps. They talk a lot about AIP. But in our checks, where we talk to partners and we talk to industry participants who are working with CIOs of Global 2000 companies, very, very few customers are actually paying for AIP and actively using it. Are they interested and curious because of all the marketing and messaging around Palantir? Absolutely. Is that real revenue showing up in the model today? No.
Something else that struck me as I was looking at Palantir, and you mentioned the valuation a moment ago, part of the narrative of this latest upswing in a lot of tech stocks has been that the PE is not necessarily rising because the E is rising, right, to meet it. You look at NVIDIA as an example. In the case of Palantir, that PE has been going up. So how much of your call is also sort of based on valuation here?
Yeah, look, valuation's a part of it, but let's be honest. If this actually was a cutting edge generative AI company, if this was OpenAI, for example, then you can make an argument that a super high multiple is deserved because that's future revenue that'll come in. We'll see growth acceleration, margin expansion, all that kind of stuff. Given that's not reality here, I feel like this is pricing in a lot of hype. This is pricing in that messaging. And I want to be very clear. I am a huge believer in generative AI technology. I think this is akin to mobile, to internet, to cloud computing. This is a seismic shift in the technological landscape. I just think the market is overestimating how big of a beneficiary Palantir will be from generative AI.
Rishi, I'll get you out of here on this. You have the equivalent of a sell on this name. How could you be wrong, Rishi? Just walk us through maybe the upside risk to that call.
I think there's two upside risks. I think the number one is they get their act together and they actually come up with real technology that generates real value and is heavily differentiated and more than Foundry that works with third-party LLMs. That's piece number one, and we're monitoring that very, very closely. I think piece number two is what we've been terming the self-fulfilling prophecy risk, because we've done work on the actual underlying technology, but if Palantir can go to enterprises and convince them that their software can do all these use cases, maybe reality doesn't matter. Maybe the marketing pitch and sales pitch is all that matters, and that results into real business, even if the technology doesn't support it. That, I think, will ultimately come to bear over the next, couple years. But if that self-fulfilling prophecy risk happens, I will be proven wrong in the near term.
Rishi, always love having you on the show. Thanks so much for joining us today. Appreciate it.
Thank you.
Coming up, the latest edition of our series, Goodbye or Goodbye. We'll get investor insight to help you make the best choices for your portfolio. Stick around. More market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're focusing on the energy sector with oil prices rising, mega mergers taking place, and the demand on the grid in focus as the AI industry picks up pace. There are plenty of investment areas opening up. What's the best way to play it right now? I'm here with Kenny Polcari, Case Capital Advisors, managing partner. And may I just say, I've known Kenny for a long time, and it is a real pleasure to have you in here to do this today.
It is such a pleasure to do this.
So
I'm
much
so happy
fun.
to be here.
Going back to my days back down on the floor of the New York Stock Exchange. So let's get to your buy stock here. It is Consol Energy, the coal company here. And you can see the stock has gone up more or less over the past year. So let's get to your case here. First of all, you say strong earnings.
So they've got strong earnings, and they're going to have stronger earnings in 2024. Expected to be $14, $15 a share, which I think actually is a little bit low. So I think they could come in even better than that.
Interesting. All right. And we're also looking, as you say, at the growth potential.
They're in this buyback, right? They're in this buyback mode, and it trades at a 4 times multiple. Its industry is trading closer to an 8 times multiple. So if this thing trades to an 8 times multiple and it earns $14 or $15 a share, we're talking $120 in the stock. Currently, I think it's trading about 85 at the moment.
Right. And then also there's the idea that There is a big new sucker of energy, if you will.
There is a huge sucker of energy, and these AI chips and these data centers that are all over the place, they just suck the energy in off the grid. I said, so we as a nation are going to have to come up with all sources of energy we can. And so as a goal, this is a coal and thermal metallurgical producer. This is not going away, right? As much as they're saying, it's coal, it's fossil fuels, all that stuff, it is not going away because we need the energy.
Well, it's not going away, except there is the transition, right? So
Correct.
So that would be the risk to your bull case here, is that we definitely have seen an attempted policy pivot away from coal.
Right, but you may have a policy pivot, but if the alternative energy is not going to produce enough energy, then we're going to go right back to what does produce energy, right? But that is a risk. So if there's more regulation, or if they force it out, or if you get the more climate change pressures, then you could see this story back off a little bit.
Gotcha. All right, so let's get to your stock that you don't like. This one is big old oil and gas company,
which is a great,
Chevron.
blue chip name. I get it. It's not so much that I don't like it, but when we're talking about where the opportunity is, I think that's right.
Chevron.
That's really what we're talking about.
All right, let's run through it then. You're talking about 10% profit margin for this company.
This has a 10% profit margin versus CIX. They have a 25% profit margin. Chevron has a 13% return on equity. CEIX has a 50% return on equity. So there's, just mathematically, those numbers are different, right? And so if you're talking about a trade, one to buy and one maybe to avoid, that's why this seems apparent to me, right?
Yeah, and another way to sort of value it here is EBITDA to market cap.
Right, to market cap. So there is 7 times, CEIX is the 2 times, and even if CEIX buys back, they continue to buy back their stock, it's still going to be cheaper on a relative basis than Chevron. So I think that's the opportunity.
Yeah, I mean, Chevron's also trying to make a monster acquisition, so we could see if
a lot
succeeds.
could change. But the risk to this, once again, is regulation, right? If my analysis is wrong, or there's a push for renewables. But look, Chevron has a big presence in renewables, so it actually could end up being good for Chevron. That would be the risk of why I'm wrong.
Gotcha. If they are diversifying the revenue streams and bring in more money,
which they are on the alternative platforms, but I think from an investment trading perspective, that short-term theory that I come up with, I think works.
And do you like energy sort of writ large? Do you think it's a good area to be?
I like energy. I particularly like energy going into 2024 and 2025. And look, if there's a change of leadership at the top, a Republican administration, I think energy is really in play if there's a Republican administration.
Okay, so let's summarize what you're telling people here with this particular play here. Buy Consol Energy based on their strong financials and future demand. On the other side, you say avoid Chevron. The return on investment is too low, as are the profit margins.
Correct.
One other thing that I wanted to discuss while you're here, you are well known not just for putting out a daily market note, but you always include a recipe in that note.
Because food and finance, it kind of works, right? Because finance can be so unnerving for people, but yet food can be so nourishing, right?
Yes.
And I like to cook, and I don't cook fancy, I cook home style. And so today I gave you zucchini surprise.
Zucchini surprise. What is the zucchini surprise?
Which is, you got to go buy the zucchinis, you trim the edges, you slice them on a mandolin so they're long.
Yes.
Right? You need olive oil, you need breadcrumbs, fresh grated Parmigiano cheese, salt and pepper. So then you slice the zucchini, you dip them in the oil, then you dip them in the breadcrumbs that you've mixed with the cheese and the salt and pepper. Then you put a slice of either prosciutto or ham, provolone cheese or Swiss cheese, whatever really you want, roll them, and then just put them in a baking dish, right? Don't do anything else. Put them in a baking dish. Put them in your oven for 350 degrees for about 25 or 30 minutes. Take them out. They're all nice and brown and melty inside. They're delicious.
Perfect.
And it's easy. You can have it as dinner. You can have it as an appetizer.
That's my goodbye today, I think, is the zucchini surprise. Kenny Paul Carey, thanks so much for coming in.
Thank you for having me. It was great.
Really
I enjoyed this.
appreciate it. All right, that does it for Goodbye or Goodbye. You got a little bonus recipe there. We're going to bring you new episodes of this 3 times a week at 3:30 p.m. Eastern.
Checking in on a few trending tickers. We are under 20 minutes away now to the closing bell on Wall Street. Let's start with Foot Locker. As you can see, that stock is nosediving in today's trade. The big news here is that the shoe chain is saying it's going to push back It's planned to expand sales to $9.5 billion by 2 years. So now the plan, which includes things like new store formats, loyalty programs, that's expected to be achieved in 2028. Company also did offer a forecast for adjusted earnings. They're looking for between 150 to 170 for this fiscal year. That is not good enough. That does undershoot what analysts had expected. And this comes after a rough year here for Foot Locker. Annual sales in the fiscal year ended in February. They actually fell, Julie, by about 7%.
Yeah, the shares have been all over the place over the past year, so we've seen a lot of volatility here. And some of the analysts, including Paul over at Citi, is saying that the way they got to comps last quarter ahead of estimates is they had to put more things on sale. And so that's been problematic for the margins there. And we've really seen, as we have come out of the inventory correction within retail, there's been sort of more dispersion. It was that everybody was seeing inventory build, everybody was discounting, and now you're seeing more normalization here, but Foot Locker is still in the discounting camp. And so there you get the pressure on the margins.
Yeah, I also thought interesting commentary on the consumer, by the way. CEO talking about how his shoppers have been hit with a lot of headwinds. Inflation, food costs, rents, he says, all reducing savings, he noted.
Yeah, exactly. All right, let's talk about JD.com. Those shares popping after delivering a better than expected rise in revenue and an earnings beat in the fourth quarter. The online retailer also initiating a $3 billion stock repurchase program, and that has been something that analysts have really been pointing to as well as something that has been positive. They like that buyback. Citi's Alicia Yap also saying, applauding the stepped up repurchase program, I should say. And the company also trying to get its pricing right, just like we're seeing with Foot Locker here in the U.S., ironically, JD also having that struggle.
Also interesting, against the backdrop, of a domestic Chinese economy, which is shaky with the property crisis, deflation, retail sales we know they've been coming in weak. So not surprising too, maybe we've heard these reports, Julie, that JD is kind of ticking the tires on some opportunities overseas, including the UK.
Yeah, and by the way, even though sales beat, the net income was below estimates, something interesting to point out there.
Yep.
All right, coming up, we're looking at how to navigate the recent losses from the Magnificent Seven with today's playbook.
Apple shares on track for their 6th straight decline. The stock now off 10% from its most recent high. Jared Blickery is here with a look at the next levels traders are watching. Jared.
Thank you, Josh. It's getting ugly out there. We can see behind me, this is a year-to-date chart in Apple, and we just fell out of bed because 180 was a support level to watch there, and we have now traded under it for about 3 straight days. Now, I'm going to go to a 3-year chart so I can show you some of the levels that are of interest below the current price. So 165 is really where I think the rubber meets the road right here. So 169, pretty close to that. Then you have the 150 area. I also include maybe 145. But then the real biggest support that I'm seeing is around 120 to 125, and that is way down there. Now, that would be an extreme move, and it probably wouldn't happen overnight, and it doesn't have to happen overall. But one of the interesting things that's happened over the last few days is the market has come down so fast. Apple stock has come down so fast, it is oversold. And in fact, there's something called the relative strength indicator. It is now printing a 22 out of 100. Now, anything under a 30 is considered oversold. And when this happens, a lot of times there's a mean reversion. So I ran the statistics, and here's what it's looking like for when we get a drop below the RSI below 25 and then a pop back above. Going back 25 years, it's happened 12 times, but the statistics are really bad over the next few days. Negative over the next 2 days, the next 1 week, the next 2 weeks, and 1 month. You have to go out to a quarter. So it might not be the best time to be buying Apple right now. And I'll just close with an Apple seasonality. This is average returns per month. And you can see through May, generally pretty positive here. So we do have that slight tailwind of positive seasonality, but could be some more pain in terms of, more pain potentially in the short term here, guys.
Thanks, Jared. Appreciate it. We'll be watching. With just over 10 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. While it's mainly big names like NVIDIA and Meta making headlines for record gains, we are taking a closer look at where and why investors can find value within the tech sector. Joining us now, Doug Clinton, Deepwater Asset Management Managing Partner, and Corey Johnson, the Futurum Group Chief Market Strategist. Thanks, guys, for being here. Corey, I want to start with you because usually we think of growth and value as sort of being diametrically opposed. But when does it make sense for investors to look for value in tech, traditionally a sort of growthy sector?
Well, yeah, I mean, there are classical definitions of these types of names, and historically we've seen tech as growth, and indeed a lot of tech companies without any profits are hard to value as value stocks. But I think a lot of that has changed over time, and we've seen, the king of all value investors, right, Warren Buffett, with his giant holdings in Apple, and in this notion that technology can't be value is just wrong. And then there's timing, and that's when investors have to think about what they're investing for, what kinds of returns, and when they need them. And to understand if it's worth a long wait, if there are some things that are willing to be more speculative, and what the timing is for those investments to figure out what the market is favoring at that moment. There are times when the market loves value stocks, and there's times when the market hates it.
Doug, I want to bring you here in as well, and it's great to see you. As you note, Doug, finding deep value in tech can be a challenge, but you have some names for us. One is SK Hynix. Why would that name, Doug, maybe fit the bill here?
Josh, if you rewind the clock a year, NVIDIA probably was the greatest value in tech. It might have been the greatest value stock, period, over the last year in hindsight, because if you had a crystal ball, the stock at one point probably traded below 10 times forward actual earnings. The business is growing so fast. To your question about Hynix, Hynix is a memory supplier to NVIDIA. So NVIDIA uses Hynix's high bandwidth memory in their chips that are in huge demand right now from hyperscalers and now potentially sovereign nations and other industrial companies that are building their AI infrastructure. So we see Hynix, which is a holding in our Deepwater Frontier Tech Index that powers the Loop ETF. We see Hynix as a potential beneficiary of continued demand for those NVIDIA chips.
Doug, something I'm curious to get your take on when it comes to something like an SK Hynix, which, as we know, semiconductors traditionally have been a commodity business, and memory chips particularly so. Do you see the AI cycle smoothing that out, making that business less commoditized?
I think in the medium term, yes. And so there is some nuance to this answer. I think that the AI cycle that we are just entering into right now will last likely longer than many of the other cycles that we've seen in the past. I think we're going to have a very long road of infrastructure build to support AI, because right now, the way that AI models work, intelligence is wholly dependent on electricity and chips. And so as long as that is true with these models, and I think it will be true for several years from now, we're going to have to continue to build data centers that house thousands of these chips. And even though memory has been a little bit commoditized in the past, there's really only three big memory vendors. It's Hynix, it's Micron, it's Samsung. And I think Hynix has been on the front end of really aggressive development of new memory products. And that's why I think they'll stay in the lead.
And one more quick one for Doug. Would you prefer SK Hynix, Doug, over its big rival, Micron?
I think you can own both. And here's the thing that's actually a challenge, just a nuance for US investors. Hynix is a Korean listed stock, so it's a little bit hard to get access to it. You can get access in the Loop ETF I mentioned a little bit earlier. For Micron, obviously that's a US listed stock. If you want to play just memory broadly and you want direct exposure, Micron's the easier route to go.
And so, Corey, I'm going to take it to you and see what you might be looking at here in the sort of, given the parameters of what we're talking about here, value in this market.
Well, I have so many thoughts, right? So DRAM is DRAM, and the DRAM manufacturers have always told us that they're DRAM special, and the market has always told us that that's not the case. And I think what we really know, so whether it's Samsung or Hynix or Micron, DRAM prices are extraordinarily volatile because they are. It is easier to swap out DRAM than it is a CPU. It is easy. A graphics processor is so difficult to swap out. That's why you've seen such fantastic top line growth from NVIDIA. And I think to Doug's point about value, I mean, I've been kicking myself for not owning NVIDIA in my personal accounts and in my portfolio. And yet I looked the other morning and one of my biggest holdings for years has been Comfort Systems, which is not a stock recommendation, but it's just an observation that I was to try to stop from kicking myself, was looking at this company, Comfort Systems, that is HVAC repair, right? Nothing less sexy, nothing more value-y than this notion of fixing HVAC. And yet the performance in 3 years is almost identical to that of NVIDIA. So, and my point is that this market is actually a little more kinder to value investors than it has been for years, and that we really are seeing winners separated from losers within technology and outside of technology. If you look at just today, right, look at CrowdStrike and how well that stock is performing compared to what's happening with Palo Alto Networks. Palo Alto Networks came out a few weeks ago and told us that they were seeing, was it a week ago? At the time is flying, telling us that they were seeing customer fatigue, and yet you see CrowdStrike going out to the same kinds of customers saying those customers are happy to buy. It suggests that the companies are performing differently and the market is able to determine winners from losers. A stock picker's market is a necessary element to a value stock performing. And what we see right now is, while we are at all-time highs or in and around in the S&P 500 and the Nasdaq and beyond, what we're seeing is the market really is distinguishing between winners and losers. And NVIDIA has been a fantastic winner. And to Doug's point, it's still on a PEG ratio, a price to earnings growth ratio, a lot more affordable than many other companies, even in the same sector.
And Doug, I'll bring it to you and get you out of here on this one. I'm going to switch gears here, Doug, just because I'm very curious about your answer. Your firm, Doug, it owns Alphabet, and there's a stock where, listen, it's in the red so far this year, Doug. There's been this real criticism, and you've heard it, of the company. It's just not moving fast enough when it comes to AI. As a shareholder, Doug, do you share that worry?
We've been super frustrated, I would say, Josh, in terms of the speed of development with AI. Google, Alphabet, they have all the tools, all the components they need to be the real runaway leaders in AI. They have the data, they have the team, they have the distribution through products like Android and Chrome. They just haven't had the pace that OpenAI has had. And that's what you see when startups like OpenAI disrupt incumbents. And that's a worry for us. They still have all those ingredients. That's why we haven't sold the stock yet and why we're still optimistic. But it has been frustrating for shareholders. And I think you're hearing more of that. I think eventually the company needs to make a statement, make a move, have some sort of almost a meta-like moment. A year ago, where they moved into a year of efficiency, they need something to light the fire again to put those assets into motion.
Doug, Corey, thank you guys both for joining the show today. Really appreciate it.
Thanks, guys. Good to see you both.
Thanks, Josh.
Or all three of you, for that matter.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the close of bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Josh and I, joined by Jared Blickery, to get you up to speed on the action from today's session. Let's see where the major averages ended up and start there. We actually saw the Dow bouncing a little bit off the lows of the session here, finishing the day higher by 76 points, a gain of about 1/5 of 1%. The S&P 500 up about 1/2 of 1%. The Nasdaq similar here, up 0.6 of 1%. What's notable to me is that both the smallest and the largest also helping lead today. The Russell 2000 up 0.6 of 1%, and so was the Nasdaq 100 up about 2/3 of 1%. So diverging there, but from their sort of large brethren. And then also wanted to take a look at the 10-year note. There we have it. Given that we heard from Jay Powell today, but given that there wasn't really a big change to a movement of when the Fed might change rates. We saw just a 3 basis point decline in the 10-year yield to 4.1%. Jared's got a closer look at today's sector action and more right now. Hey, Jared.
Julie, defensiveness a little bit today. We did have tech leading earlier, but not in the end. Utilities and staples, those round out the top two, followed by materials and then tech and then healthcare and real estate. But really, we have consumer staples. That was the winner today, or the second best winner. And then consumer discretionary, that's the more retail discretionary oriented part. That was down 34 basis points there. And when we take a look at the Nasdaq 100 here, another monster day for NVIDIA, well over 20 new highs this year alone, and notch another one. It's up to $887. AMD, another record close. JP Morgan, Costco, Progressive Financial. So another broad swath of leaders emerging here in this market, Josh.
And Jared, listen, we've got to talk about one stock to watch. That would have to be CrowdStrike today. Look at the surge that stock made, up about 11%, reported Q4 results that beat the guidance, also pleasing the street. Interesting in this cybersecurity space and how it's kind of playing out. Some like CrowdStrike clearly capitalizing. Others, by the way, like Palo Alto Networks, have disappointed investors. We did speak with Piper's Rob Owens on the show. Bottom line, he says this cyberspace for now sets up as well as any he has seen in the past couple decades. By the way, tomorrow, remember, CrowdStrike CEO George Kurtz will be on Yahoo Finance. Can't miss an interview there, Julie.
Yeah, and that's something that Corey Johnson just talked about, that it's interesting here that we are starting to see companies differentiate themselves even in the same space, which he said is a better environment for stock pickers market here. Morgan Stanley analyst Hamza Fodorwala saying today there is no spending fatigue here when it comes to CrowdStrike, which is interesting given what we heard from Palo Alto. So I imagine as we get through the coming quarters, we'll get a little more color on whether it's an execution issue, whether it's an overall demand issue, and what's going on in that
This
space.
stock, by the way, now up about 160% in the past 12 months, but analysts not deterred, overwhelmingly bullish on the street.
Interesting. All right, some of the names in the Magnificent Seven are looking less than magnificent as of late. Both Apple and Tesla ending the day lower after several sessions of declines. Yahoo Finance's Madison Mills here with her takeaways for the day. And this kind of speaks to what I was just saying, is that we're starting to see some of these divergences.
We're seeing the divergences, and we're getting a lot of fun, pithy names from the street. Josh and I were talking about this. The 3 AI amigos you mentioned.
That was Gene Munster.
Steve Sosnick today telling me it's the Fantastic Four, which I find interesting. My take, which people would pay millions of dollars for, of course, is that there are 3 winners, 1 survivor, and 3 losers here. So you have Apple, Tesla, really struggling year to date. And I want to talk about their exposure to China, because that's one of the primary drivers to the challenges that they're having with Tesla. We've got weak deliveries in China. Apple's local iPhone sales are struggling. And then you have Alphabet, which announced a AI-driven image search functionality earlier this year that they had to take off the market in under 24 hours because of challenges with that AI. That leads me to my second point here. The AI and mentions of AI are not enough. You actually have to be able to use it. Imagine that. It has to work in order for the market to be happy about it. And there's really no better case for that than NVIDIA, which, by the way, as Jared was mentioning, that sea of green over there, NVIDIA has maintained that sea of green this week, even when we've seen some sell-off. So continuing to see NVIDIA lifting up the broader market here. In terms of what's next, it seems like these AI plays that can win on not only the use case, but also the fundamentals, keeping those sales up in spite of any, decreased sales out of regions like China. That is going to be the key for this rally moving forward.
It was interesting to talk about that AI thing. We just spoke to Doug Clinton over Deepwater, and his firm's a shareholder, but clearly expressing some real frustration there.
Yeah,
with Alphabet, you mean?
With Alphabet, yeah.
It doesn't work, and so if you introduce something to the market that doesn't work yet, you can't really be surprised when people aren't happy about that, I would imagine. But then I'm interested in Microsoft. Obviously, they're up on the year still. I think we have a chart showing the Magnificent Seven names compared year to date. They were the clear winner of AI because of OpenAI, of course, but really trailing the likes of NVIDIA, of course, in the Magnificent Seven trade year to date. And I'm curious about whether they're going to be able to have a catalyst for more growth moving forward on AI, or if that's just priced into the name at this point.
Well, it's also interesting as we talk about now that some of them are lagging, and yet up until a couple of days ago, the market was continuing to make new highs, which sort of lends credence to the idea, as some strategists we've been talking to have been saying, that there is a broadening that's been happening. Nancy Tengler, I think, called it a quiet broadening, right?
Stealth broadening.
Stealth broadening
Yes.
in the market that's been happening. So the idea for so long that the market could not go up unless all of these guys were going up, that now seems to be going away a little bit.
Yeah, we had this UBS note saying rain or shine, whether you've got the Fed raising rates, higher for longer, cutting rates, or whether you have all of the Magnificent Seven performing well. To your point, Julie, it seems like this market is going to go up regardless. As long as NVIDIA's there, we're good.
Stocks go up?
Stocks go up, yes, exactly.
Madison, thank you so much. Appreciate it.
Thank you.
Moving on, we are taking a look at the bond market here. Treasury yields pulling back after Fed Chair Jay Powell said the central bank isn't ready to cut rates just yet. Just joining us now is Steve Lapley, global co-head of iShares Fixed Income ETFs at BlackRock. Steve, great to see you.
Thanks for having me.
So as we mentioned there, Jay Powell testifying today. I think he did, Steve, exactly what he wanted to do, which was make no news, right?
Yes.
But what did you make of the testimony? Any big takeaways?
I think he's reinforcing the messages they've been really trying to get the market on side with, which is they want to be patient, they want to watch the data roll in, they want to have conviction that inflation's going to keep grinding down. There's a lot of debate about some of the recent inputs into the calculation, but nonetheless, I think they're trying to make it clear that they are going to keep watching the data roll in. And there is a scenario here where I think they're comfortable with the labor market being strong as long as they continue to see inflation fall.
From the bond market perspective, has the Fed done a good job? In other words, the Fed frequently comes under fire. They came under fire. Jay Powell came under fire in Congress today, as he always does. But do you think that the action that we have seen in prices has indicated confidence in the Fed and sort of a smoothness of reaction as well that doesn't indicate alarm?
I think that what you're seeing in the market is a comfort level with, financial conditions where they are. I think there is a little bit of concern that, conditions loosen quite a lot towards the end of the year. And they want to try to continue to keep those in check because what they don't want to have happen is see a dramatic loosening and then a view that wealth effects and everything else could start really driving pressures back up. So they seem to have, if you want to measure success, they seem to have successfully moved the market off the 6-cut narrative, right? They moved it off and they pushed the timing back to some degree. So, we went from March and now we're out to June and we went from 6 down to 3+ cuts. So they were successful in realigning the market to that view.
Steve, let's say the Fed does engineer a soft landing. Rare, tricky, but let's say they pull that off so inflation comes down to 2% without a downturn. For fixed income investors who are listening right now, if that is the scenario, where would be the opportunity?
So in that case, you can broaden out your portfolio in fixed income. So including, you do want some ballast, so you should hold, let's call it some intermediate treasury exposure for that diversification and ballast. You can then actually get comfortable in that scenario of soft landing, holding high yield is one example. So, for treasuries, something like IEF. For high yield, you can hold USHY, HYG, HYDB. All of those products, will give you that extra income boost. And also, in a soft landing scenario, you're not really expecting spreads to widen out. And so you can then rely on that income without having to worry too much about possible drawdowns from spread widening.
And do you think the soft landing scenario is the most likely one?
I think it is still our base case, with some caveats. There are a lot of things that can happen as we sort of progress forward here. But I mean, it does look, and there may be a lot of things going on with this. With, for example, you guys were talking about AI or their productivity effects that are coming in that are allowing the labor market to remain strong without increasing, price pressures too much. So we have to see how those things play out, but I think that's still our base case.
Let's say, Steve, it's not, I don't think, a popular opinion, but let's say Larry Summers is right. And Dr. Summers, I think, recently said, I think he put it like it was a meaningful risk, in his opinion, that the next move in rates is actually upwards, not downwards. If that's right, Steve, how does that change the calculus for fixed income investors?
Yeah, so that's an interesting one. So let's just take that scenario. If you do see a strong CPI print or other coincident indicators that would kind of lead them to conclude that, we thought we were restricted, but maybe not. And then they may very well start to tighten. So in that case, you go back to the short end playbook. So what does that look like? That looks like T-bills like SGov, Treasury floaters like T-flow. You just want to be in short duration. You want to ride those short rates. And short dated TIPS. So for monetizing that inflation without taking too much interest rate risk. So STIP as an example would be a way to do that. But you'd have to revert back to that book, while you're waiting for this to kind of calm back down. But again, possible, but I think the base case is still, they seem to be heading on this trajectory.
Would you agree with, is the BlackRock review summers, would you call it meaningful risk or something different?
I'm not sure I would quite know how to quantify it yet. I think we do need to see some more data to really get a handle on that. I mean, is there a non-zero chance? Of course. And I think, the recent data that's rolled in, PCE fortunately came in at expectations, but I think some people really wanted to see that number moving down more sharply. And I think what Dr. Summers is saying is that, hey, if this becomes stubborn and sticky, it's a possibility.
And do you think it is reassuring to the market that Powell is sort of hammering home the message that the Fed will begin to move, even if it's not all the way to 2%, if it's they feel confident it's approaching 2%?
I think that's right because with the risk that they are trying to handle is that, as the lag effects. So it's one of those things where you have to be a little bit careful because you don't know exactly when you're going to land it. And so if you stay restricted for too long, you'll overshoot, right? And so it is a challenging thing to be able to get that exactly right. So I think that's why they're being very attentive to it. And if they see the momentum continuing like that, that's when they may decide ultimately that they can pull back. But they want to see a few more validation points on that.
A bit more good data, I think that's what I would put it. Steve, thanks so much for joining us today. Really appreciate it. Fed Chair Jerome Powell testifying today and is heading back to the Hill tomorrow. We're going to be diving deeper into the comments on the other side. Stay tuned. More market domination overtime coming up right after this. President Biden giving his State of the Union address tomorrow. Biden will look to assure voters about the strength of the economy, something many Americans consider is in poor condition, according to a recent New York Times Siena poll. For more insight on tomorrow's State of the Union, we have Yahoo Finance's very own Rick Newman. Rick, what's he going to say? What are his priorities?
I think what he does is more important than what he says. What Biden needs to show up on Capitol Hill and do 25 jumping jacks, 10 or 20 sit-ups, maybe take a couple laps around the inner chamber, demonstrate to America that he is the most vigorous 81-year-old in the nation. And then it doesn't matter what he says. Yeah. Now, I don't think he's going to do that probably, but you know, I'm only half joking
but
here.
Then you would really get the numbers up. Now that is something people tune into.
I mean, look, he clearly, the number one thing he has to do is not fall over or have a senior moment or demonstrate in some way that concerns about his frailty are valid. And I think he knows that. I think his campaign knows that. There could be some heckling from Republicans in the crowd trying to see if they can goad him on, maybe sucker him into a weak moment where he flubs or says something off the cuff or confuses the leader of this country with that country or so on. I think that is actually more interesting to political analysts at this point than what he's going to say, because I think we kind of know what he's going to say. It's what he's been saying in his speeches around the country for the last 6 or 9 months. The economy is strong, labor market is strong, but we still have work to do. He's going to definitely highlight the things that he thinks he's done well and that he wants to do for the next 4 years. I think we're going to hear about getting drug prices under control, other efforts to get prices down. He's on this thing about junk fees lately, corporate greed we're going to hear about. It's not his fault, inflation up, it's all the big greedy corporations and stuff like that. And, you know, I've seen some analysts say, you know, could you shorten the speech, please, because not that many people watch it anyway, and by an hour and a half in, I think this thing is overplayed every single year. I mean, the political geeks get all excited about it. Last year, the audience for the State of the Union was about 1/4 of what it was for the Super Bowl. I'm surprised it was that high last year.
Truly, yeah. That's shocking to me.
Yeah. So are more people going to be interested now that we are effectively into the general election campaign? I don't know. But, you know, this is usually a milquetoasty event that is not decisive one way or another. So that's why Biden just has to get through it with his, 2 feet on the ground.
You know who I've been thinking about recently? Ronald Reagan. And
because?
Because he was old when he was in office. Sorry to put it that way, but he was old. And as we found out towards the end, he had Alzheimer's, right? So, and I am not old enough to really remember his performance towards the end.
But the difference is that at that point, he wasn't running for re-election.
Correct.
That's correct.
Yes, I guess that's the big
Well, one
difference.
thing that Reagan did that is relevant is he turned his age to his advantage by, making some fun of it. He
jokes were great.
He famously said in that one joke, I don't want to make age an issue because I don't want to exploit my opponent's lack of experience. He turned that into a joke. I mean, Biden has been trying to do that. He went on late night recently, he made a reference to when he ran for his first political office 800 years ago. I mean, he's been trying to do that. I think that is a good idea if he's actually kind of funny and he's not cringy. I mean, if it has to look. Reagan knew how to deliver a line. He was an actor, and that line, without a doubt, was rehearsed. But it didn't look rehearsed because he delivered it well, So if Biden comes off delivering what are supposed to be zingers, but it looks like he didn't practice enough in the mirror or something like that, it won't work. But like it or not, and by the way, Trump is not spry either. I mean, there are videos where he drags his right leg. What is wrong with Trump? He doesn't look like he's too swift on his feet either. So it's not just Biden.
They're both old.
They are.
All right, Rick Newman, thank you very
Bye,
much.
guys.
Appreciate it.
Thank you, Rick.
Well, Federal Reserve Chair Jerome Powell testifying in front of the House Financial Services Committee today, kicking off 2 days of congressional testimony. The word from Powell is that continuing progress on inflation, quote, is not assured, but the central bank is still expecting to cut rates later this year. Joining us now, Senator Cynthia Lummis of Wyoming. She serves on the Senate Banking Committee. Powell's going to be in front of that committee tomorrow. Senator Lummis, thank you so much, first of all, for being here. We really appreciate it.
My pleasure.
And so I would start with I'm curious what you want to know from Jay Powell tomorrow when you get the chance to question him.
Well, I'd like to visit with him about a couple things. One is about quantitative easing. Of course, we've seen that as the Fed has printed more and more money, that it has helped drive up inflation. And now they're saying that they're not ready to reduce rates because inflation is still an issue. And I want to know what, in the long term, quantitative easing it looks like. And if they were to do quantitative tightening, would Wall Street balk? And how do we get back to some sort of equilibrium with regard to how much money we have circulating in our system? I'd also like to visit with him just about how much individuals are affected by this inflation. Because even though the economic indicators that the Fed looks like are different from what happens to the consumer, the everyday consumer is paying way more for gasoline, for groceries, for natural gas, for rent. And so the Federal Reserve can tout all day long that the economy's getting better, we're not going to have a recession, that we'll be able to cut rates at some point. But if the American people don't see that, they continue to lose buying power compared to their paychecks. So when will the reduction in inflation that the Fed sees hit the everyday consumer? When will it affect grocery prices, gasoline prices, rent, and the things that people buy every day? The everyday consumer is not sharing in what the Fed sees as an improving economy.
And Senator Loomis, it's great to see you. I want to switch gears here a bit to another topic, Senator. You know, we had Skybridge founder Anthony Scaramucci on with us this week, and he thinks that Bitcoin would be better off under another Biden term. Take a listen, Senator, to what he had to say.
Mr. Trump is going to lose this election. Joe Biden will get reelected, and that will be generally good for the markets, which are at an all-time high, I might point out, during the Biden administration. But it'll also be very good for Bitcoiners because you may not like the regulation coming out, but at least there's a predictable process to the law.
And Senator, you heard Mr. Scaramucci there, a Bitcoin bull if there ever was one. What do you make of his comments there?
Well, I disagree with him that there is a understood regulatory framework right now. There's not. What I hear from the industry is the lack of a regulatory framework means that they are regulated by enforcement actions that include penalties. I think that the industry would rather have Congress legislate on this so they have a clear regulatory framework going forward. And that only comes through legislation. It doesn't come through enforcement action. Now, I do think that Bitcoin is going to be fine. The 11 exchange-traded funds that were approved earlier this year, including by some of the longest names in financial services that are very stable, are going to bring people into the Bitcoin exchange-traded fund that will finally have a comfort level, that that's a place that they can get involved in Bitcoin that doesn't make them uncomfortable. Then the other thing that's going to happen with Bitcoin is it's going to go through a halving in April, which means half as many Bitcoin will be produced every 10 minutes. So the scarcity that's built into the protocol for Bitcoin is going to start kicking in its ability to go up in price because we're going to have a more hardened asset. The more people that are in Bitcoin, the more hard, meaning secure, that asset gets. And it's just going to drive up the price. So I disagree with Mr. Scaramucci that we really have a well-understood regulatory framework. That's why Senator Kirsten Gillibrand and I continue to push for the Lummis-Gillibrand Financial Innovation Act.
What do you think is sort of the most urgent thing that needs to be enacted in terms of that crypto regulation? I mean, you're talking about Bitcoin, Ether, which are sort of the more established coins, if you will. I mean, but at the same time that we've seen this recent crypto rally, you see stuff like Dog with hat, I believe is what it's called, is one of the other altcoins that's seeing a rally here. Do you think that there needs to be more guardrails around some of those altcoins?
Absolutely. There are, thousands of altcoins, and they are alt, meaning they are alternatives that don't have a clear regulatory framework. A number of them are securities. They're not commodities like Bitcoin is. So if you know something's a commodity like Bitcoin, it would be regulated by the Commodity Futures Trading Commission. But some of those that have the incidence of a security should be regulated by the SEC. And we don't have that regulatory framework to clarify which is which. So some of these altcoins, for people who think maybe Bitcoin is synonymous with cryptocurrency, it's not. The only thing that you can clearly put your money in right now and know that it's a good store of value and a solid means of exchange going forward is Bitcoin. A lot of these other altcoins are highly speculative. And so we need consumer protection here, and we don't have it.
Senator, I want to get you out here on this. I'm just curious, Senator, do you think we might see a spot Ethereum ETF this year? I mean, let's be honest. It took a lawsuit to get Chairman Gensler to approve a spot Bitcoin ETF. Do you think we might see a spot Ethereum ETF?
I don't know. I think it was so much more logical to do a Bitcoin ETF first, because the fundamentals of Bitcoin and their protocol are so well understood. They're so secure that the Bitcoin ETF made sense to me. With regard to Ethereum, it might take a little more time to make sure that it has some of the same clear fundamental safety measures in terms of consumer protection that Bitcoin has. So that might take a longer investigatory effort by the SEC, and I don't know if that could be accomplished before the end of the year.
Senator, thank you so much for joining the show today. We appreciate your time and your insight.
Yes, my pleasure. Nice to see you.
Nice to see you. Time now for what to watch Thursday, March 7th, starting out with the Fed. Fed Chair Jerome Powell wrapping up 2 straight days of congressional testimony in the morning. Tomorrow, he's going to be answering questions from the Senate Banking Committee. Powell taking a cautious stance on when the Fed will start cutting rates, but did say he still expects it to happen later this year.
Moving over to earnings, a somewhat busy day on the calendar, even as earnings season winds down. Broadcom, Costco, Kroger, Marvell Technology, and Gap, they all report tomorrow. Broadcom announcing first quarter earnings after the bell. The semiconductor giant has been on an absolute tear. The stock up about 20% to start the year and more than 50% over the last 6 months.
And taking a look at the economy, we're going to be getting more insight into the state of the consumer tomorrow afternoon with the latest consumer credit report. Economists expecting the number to jump for the month of January as the bills come due from holiday spending. This happening against the backdrop of the Biden administration seeking to impose a new limit on credit card late fees.
Yeah, that's one of the things that we could expect discussed in the State of the Union. All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned, more Yahoo Finance coming your way on the other side.
Insane and volatile. Just two words, how our next guest describes the last 24 hours in Bitcoin trading. Bitcoin hitting a new all-time high and then plunging, only then climb higher. It has been a rocky road for investors trying to digest the moves and may what come next. Joining us now is Scott Melker, crypto commentator and host of the Wolf of Wall Street's podcast and YouTube series. Scott, it is good to see you. I don't know, Scott, if we should ever try and make a call on where Bitcoin is headed in the near term. It sounds tough, but the surge has been incredible. I mean, we saw, of course, the drop yesterday, but still, I mean, a move of 50% already this year, Scott. Interested just high level, what do you make of the move we've seen, Scott, and where do you see us headed from here and in the near to intermediate term, let's call it?
Well, first of all, I think that anyone looking at Bitcoin on a daily basis should just zoom out and calm down, because we see this kind of volatility. We literally just call it Tuesday in the crypto market, and it happened to have been on a Tuesday. But no surprise when there was leverage built up and massive open interest that we saw a flush of that leverage. And that's all it was yesterday. We saw $1 billion liquidated, which is pretty insane. But if you're wondering what is driving this fundamental move, it's obviously the approval of the Bitcoin spot ETFs. And in advance of that, the narrative that those Bitcoin spot ETFs would get approved. We're seeing absolutely massive daily inflows. Even with the drop yesterday from 69,000 down to 59,000, we saw over 700 million into IBIT, which is BlackRock's spot ETF alone. So with that much buying, we can see these flows. It's very transparent. We have a fundamental reason why we're seeing Bitcoin continue to rise, and I don't see those flows stopping anytime soon. And the reason for that is because they haven't even been unlocked, these products, for most RIAs, for most institutional platforms. We know Vanguard doesn't even offer these products, and maybe they won't. Merrill Lynch just approved a few of them. We have RIAs like Carson Group, the 30 billion asset under management group, that has now approved 4 of these. So this trickle of approvals, people doing their due diligence, has just started. So as more of them come online, we're definitely going to continue to see a lot more buying of these spot ETFs, which means a lot more buying of spot Bitcoin.
Scott, so just to be clear for viewers, people weren't, Carson Group and what have you, weren't buying crypto before because for regulatory reasons they could not add on behalf of their clients' portfolios, or Bitcoin wasn't liquid enough, or they weren't recommending it? Talk to us about that.
I think it's primarily the former, right? There wasn't a way that a lot of these institutions could, in a manner that, as a fiduciary, could approve going to Coinbase and custodying your own assets. But if you want the more cynical answer, it's that RIAs only recommend things that make them money, and they weren't going to make money by sending you to Coinbase to buy spot Bitcoin. Now that we have the ETF, the minute they were approved was the moment that they started to do due diligence. Most of them didn't even believe that these were going to be approved in the first place. There was a lot of surprise. They didn't want to waste their time, obviously, starting to talk to their clients about products that didn't even exist yet. So that's why now they're doing the due diligence. They're coming online, and they're going to start selling them. They're going to be able to charge that management fee on these spot ETFs like everything else. Eventually, we'll be seeing these used as collateral. They're becoming really traditional financial assets if you're buying it through the ETF. Now, that's not the same as buying spot Bitcoin, to be very clear. I still think that people should buy Bitcoin themselves, custody it themselves, really own this asset class. But this is still huge fundamentally for the market. But no, I don't think it was because fear of the asset or illiquidity, or even the fact that it's so volatile. I mean, listen, Facebook, Meta, had a larger drawdown than Bitcoin in the last bear market. So there's a lot of corollaries for this in stocks and other assets. It's just the fact that they weren't online yet, and now they're taking the time to actually do it. I mean, how often does someone really call their financial advisor? Once every 3 months, once every 6 months? These just got approved.
Scott, I want to get your take on another, what's talked about as another potential catalyst, the so-called Bitcoin halving, which is fast approaching here, Scott. April. Historically, Scott, what has that meant for Bitcoin?
So historically, we have a 4-year cycle in Bitcoin that's largely driven by the halving. Now, for being honest, 3 halvings and Bitcoin was a different asset each time. That's not really statistically significant. But what we generally see is the new supply, as Senator Lummis was talking about before, the new supply cut in half. And then usually we see that digested into the market over the next 5 to 6 months, sort of a boring summer. And then in the fall, we see Bitcoin go parabolic and have these massive moves to the upside, breaking new all-time highs, doubling, tripling the all-time highs into the next year. What's interesting, though, is that we've never seen a new all-time high made like we did yesterday. before that halving. So this time is different. I know those are the four most dangerous words in investing, according to Sir John Templeton, but this time has been different. So you would expect with this level of demand and supply reducing that we're going to see much higher prices. It's really economics 101.
Do you have a price target, Scott? And I'm asking that because a lot of folks out there have price targets, and I wonder for investors, should they think of a Bitcoin target the same way they would think of a stock target, for example, because modeling Bitcoin can be kind of tricky.
Well, my Bitcoin target is to die and hand it off to my kids and hold it forever because I truly believe in the asset. That's not necessarily true of the rest of the market. I view the rest of the market as speculative VC investments, which I think is totally fine, but they're better for trading. Bitcoin, I believe, is better for holding. I'm in the Michael Saylor camp on that. So giving targets obviously is dangerous. I don't have a crystal ball. I don't know it better than anyone else. But if we look at past halving cycles, you generally do many multiples of the previous all-time high. Each cycle has been more muted than the last as the asset matures, as the market cap obviously increases. It's harder to move. But last time, say we had a 20,000 top, we managed to do a 3.5x up to about 70,000. A 3.5x up from that 70,000 high is putting us well into the 200s, right? So let's say that we have a more muted cycle. We do a 2.5x. I think that easily puts us in the 150 to 200,000 range conservatively. People think those numbers are crazy, but when you think about it in percentages and you look at history, it's literally nothing. But for me, I'm looking much beyond this cycle. I don't care what happens in the next 2 years. I don't care what happens in the next 10 years. I think this asset's going to 500,000, a million eventually, because we know how irresponsible the government is with their money.
Scott, appreciate you joining the show today. Thanks so much.
Thank you.
Coming up, weight loss drugs could cost taxpayers big time unless Congress takes action. More on that when Yahoo Finance returns. United Health Group and the U.S. Department of Health and Human Services are laying out action plans following the cyber attack on United Healthcare, Change Healthcare, a unit of United Health Group, he said. Our health reporter Anjali Kamlani is here with the very latest. Anjali.
That's right, you guys. Yeah, we know that, of course, the Change cyber attack has been in the news for the past 2 weeks, really creating problems for hospitals, doctor groups, and pharmacies. United Health came out with a lengthy statement yesterday saying that they are back online mostly with pharmacies, so they're at about 100% and should be reaching there by the end of this week. Meanwhile, looking at hospitals, they're at about 90% back online with claims. Now, just to recap, Change Healthcare does processing of payments and claims and prior authorizations for these entities. And so what really happened is, in addition to United coming out with giving that update, the U.S. Health Department has now intervened because of how problematic this has been, stopping payment altogether for some health entities, including doctor groups and the like. And so they've found a way to help these groups find alternate payment routes, as well as are asking for leniency on things like prior authorization from other insurers in order to be able to continue the flow of operations, essentially. I mean, if you think about it, CVS, for example, had 25% of its claims going through Change Healthcare. So just to give you the size and the scale of what this Change deal is, we've heard about cyber attacks in healthcare over the years, but this is the largest one because it really hits at a key part of the pipeline of healthcare, and that is sort of the payment systems and just how interoperability, which is, not enterprise and closed off systems work. And one of the key things for United Health is just how large a role it plays in the economy of healthcare. We know it's one of the largest employers of providers, but it also controls a lot of healthcare dollars. If you take a look at it, not only do they have Change, but they also have an entire arm dedicated to finance that includes HSAs, FSAs, other wellness benefits. In addition to all that, they finance affordable housing and get low tax credits based on that, as well as are the owners. They acquired one of the largest processors for payments for the WIC program, as well as for Medicare. They're involved in that as well. So it's a lot of healthcare dollars under one roof, which is why there's a lot of focus on this and the question of whether or not they're ready and prepared, and other health entities are ready and prepared as they start getting more into the tech space to counter some of these potential attacks.
And prevent them, hopefully, before they even start. Anjali, thank you so much. Appreciate it. Well, there is hope for America's obesity epidemic thanks to the rocketing popularity of weight loss drugs. But those so-called miracle injections could come at a steep cost for U.S. taxpayers unless Congress takes action, as outlined in a recent New York Times op-ed. We're joined now by one of the authors of that article, Jonathan Gruber, MIT Economics Department Chairman. Thank you so much for being here. So, as you wrote in the op-ed, the costs of these drugs are indeed quite onerous, and there have been a lot of concerns raised about, eventually will only wealthy people be able to afford them when it is lower income folks who suffer higher rates of obesity. So what do you do about this problem?
Well, look, let's start with the facts. The current list price of these drugs is about $15,000 a year. Let's be very clear about two things. First of all, these are great, miraculous drugs. They really seem to be a very effective way to lose weight in an arena where it's been hard to find effective ways before. And remember, once you take them, you have to take them forever. Once you stop, you gain the weight back. So $15,000 a year is forever. Now, the price might be lower through discounts or other things, but it's still much higher than in other countries where, for instance, in the home country of Novo Nordisk in Denmark, the cost is about $3,500. We estimate that at the current cost, if all obese people in America were made eligible for this drug at $15,000, that would be a net cost to the U.S. government of $800 billion a year. That's a huge amount of money. That's the cost of our Medicare program. Now, our estimate could be off by $100 billion here, $100 billion there. It's still a big number no matter what. And so we suggest that the federal government needs to aggressively consider how to reset the price of this drug more in line with the value it adds to society.
So, Jonathan, natural question for that. How do you think about what your solution would mean for innovation?
It's a great question, and one that I get asked all the time, and one I discuss in my book, Jumpstarting America with Simon Johnson, which is to remember that a lot of innovation in the U.S. is driven by private companies, but a lot of it's driven by the government. And if the government's going to have to spend $800 billion a year or something like that on these drugs, they're going to have to cut spending elsewhere, including in the valuable government funding of research and development. Government spending on the National Institutes of Health is incredibly valuable in terms of promoting innovation. And if we cut spending on NIH to allow high prices on drugs, total innovation in the US will fall, not rise.
In this case, though, in the case of GLP-1s, it didn't come from government innovation specifically, right? I mean, there is some private innovation that these big discoveries come from, right?
Oh, absolutely. Every single drug that's been discovered in the past 40 years at its base has government-funded basic science. But the private companies then take that. The key thing that's neat about government science is it complements, it works with private R&D. It doesn't substitute for it. So I'm not calling for dramatically less private R&D. What I'm saying is if the cost of allowing private R&D is starving the federal government and not allowing the funding for basic science, which is the basic of all source of all drug development, that is going to move us backwards in terms of innovation, not forwards.
What about, John, I understand that you want to make them more widely available, but would there be other ways to do that besides what you're proposing? For example, maybe could the government subsidize the cost, Jonathan? Could that be an option?
Well, basically, our estimate comes from what would happen if the government did subsidize the cost, if the government covered it for people on Medicare and Medicaid, if the government covered it for people on the ACA exchanges to get subsidies. That's where the giant cost comes from. So basically, the government could do that. It'd just be incredibly expensive. And as I said, that would interfere with a number of other priorities of the government. And once again, look, basic economics tells us that we have a well-functioning market, like for apples, we should let the market determine the price. When the market doesn't work, when consumers can't shop effectively, when there's imperfect competition, the government needs to intervene to ensure the price is set properly. That is the case here. There's no case for free market pricing of drugs. No other country in the world does it. We shouldn't either.
Jonathan, what happens to private plan pricing if these companies are, if they have to negotiate with the government for Medicare pricing? Do they try and make up for that in the private market?
Great point. The evidence on that is kind of mixed. There's certainly a concern. Once again, the proper regulation would be a social regulation, like they do in every other country, where the regulated price would apply to all payers. If the government regulates the price, there's two things that might happen. On the one hand, that could put pressure on the raised price for the private sector. On the other hand, it turns out in many healthcare sectors, private payers just follow what the government does. So private payers could just say, no, look, the government's paying you this, we're going to pay you this as well.
Wouldn't that be interesting? Jonathan, thank you so much. Appreciate it.
You bet. My pleasure.
Coming up, Apple blocking Epic Games from developing products for iOS. Could this raise scrutiny of the iPhone maker's plans to comply with a new antitrust law? We'll discuss on the other side.
Apple dealing a blow to Epic Games, the video game software company, saying Apple terminated its developer account, preventing the development of the Epic Games store for iOS. Here with the details is Yahoo Finance's Dan Howley. Dan.
That's right, Josh. This all comes down to what's known as the Digital Markets Act in the European Union. Basically, it establishes that there are certain key players in the technology space, and because of their size, they have to allow for certain capabilities for other companies. And so for Apple being a key player, they essentially have to allow third-party apps to build third-party app stores. They no longer have to rely on Apple's app store as the sole place to download apps. Now, Apple and Epic have had a tumultuous relationship, to say the least. Apple pulled the game Fortnite and Epic's ability to develop games for iOS after Epic, in a kind of showdown with the company over pricing for apps sold through its app store, went ahead and changed prices on its own and allowed a third-party means of purchasing apps through the App Store. All of this is to say they don't like each other. And now Epic is claiming that because of comments that CEO Tim Sweeney made regarding Apple's upcoming changes to the App Store in Europe, that is supposed to abide by that Digital Markets Act, the Apple has gone ahead and pulled the ability for Epic to actually go ahead and build its own third-party app store and put games on iPhones. And so this is a larger problem that Apple will have to potentially deal with when it comes to the European Union and European Commission as far as antitrust goes. It's clear that Epic is not going to stand by. It's clear that Apple is not going to abide by Epic kind of, I guess, rancoring them. And so now we're going to have to see what happens when the two come to blows.
And what does this mean for Epic in the long run?
Yeah, I mean, look, Epic hasn't been allowed to sell Fortnite on iOS for a while. They were going to be able to do this again, in Europe at least, not in the US, nowhere else, but in Europe in particular. And so it means that there's a loss of potential revenue here that could impact them over the long term.
Dan Howley, thanks so much. Appreciate it. And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.